Managerial Accounting, Multi-Product Break-Even Point, Part 2. Now, recall that we looked at the multi-product contribution margin income statement, determined the sales mix for our two products, the weighted average contribution margin ratio, and total fixed cost. Now that we have that information, we can plug those numbers into our break-even point formula and figure out how many units or what the total amount of sales is that's needed to achieve break-even point for this company. Now, remember the formula, the basic formula for break-even point in sales dollars is total fixed cost divided by the weighted average contribution margin ratio. And for this set of data, our total fixed cost for the company as a whole was $1,085. And our weighted average contribution margin was 31%. So for this particular company, in order to achieve break-even point, they're going to need to sell 1,085 divided by 0.31. They're going to need to sell $3,500 in total. This is like the package break-even point, the package of show and money at the current sales mix that needs to be generated in order to break even. Now, what we truly need to know is how much sales from show need to be achieved and how much sales from money need to be made in order for us to reach break-even point. So we're going to have to break that 3,500 down into break-even point sales for each individual product. And this is where that sales mix comes into play. Now, remember that show accounted for 40% of the total sales revenue for the company. So in order to calculate how much sales we need to have of show to reach break-even, we'll take the break-even point sales revenue for the company as a whole of $3,500 and multiply that times show's proportion of total sales, 40%. So 3,500 times 40%, $1,400 is the amount of sales that we need from show in order to break even. And we'll do the same thing for money. Money's proportion of total sales was 60%, so we take the same total company break-even sales of 3,500 and multiply that times the 60% proportion of total sales represented by money. And 3,500 times 60% is $2,100. So notice that 1,400 plus 21 does indeed equal the 3,500. So we've divvied up the break-even point sales revenue for the company as a whole between the two products. Now, you may be asking, well, what if instead of contribution margin percentage, we're given contribution margin per unit? Well, in that case, to convert the per unit contribution margin to a weighted average contribution margin, we would simply multiply. So if you've got contribution margin per unit, you will then multiply that times the sales mix. So for show it would be 40%, and that would give you the weighted contribution margin, weighted for the proportion of sales represented by each product. And then you'd take it, do this for show, and do the same thing for money, and then add the two together to get the weighted average contribution margin per unit. And then you'd plug that weighted average contribution margin per unit into your break-even point formula and do the same type of calculations. So it's pretty straightforward. Just remember that you need a weighted contribution margin for all products, and the weight is based on their proportion of total sales. And that is multi-product break-even point.